Have you ever wondered why some investment portfolios seem to weather market volatility better than others? Many investors build their portfolios around traditional investments like stocks, bonds. While these assets remain a foundation of long-term investing, they often move together during periods of market stress, reducing the diversification the investors expect. That's where alternative investments can play an important role. In today's video, we're going to discuss what alternative investments are and why investors use them and how they can complement, not replace, a traditional investment portfolio. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investing strategies. If you're new here, subscribe to my channel and hit that like button. So what are traditional investments? Most investors are familiar with traditional investments. These include stocks, bonds, mutual funds, ETFs, and cash equivalents. Stocks provide long-term growth potential, while bonds have historically offered income and stability. For decades, the classic 60-40 portfolio has served investors well, 60% equities, 40% bonds. However, today's markets are different. Higher inflation, changing interest rate environments, and increased volatility and a strong correlation between asset classes have encouraged many investors to look beyond the traditional portfolio. So what are alternative investments? Well, alternative investments are assets or strategies that fall outside the traditional stocks or bonds. For example, these could include real estate funds, private equity funds, multi-strategy hedge funds, which include market-neutral investment strategies. Each serve a different purpose. Some seek income, some aim for long-term capital appreciation. Others attempt to reduce overall portfolio volatility by behaving differently than the stock market. The key idea isn't necessarily higher returns, it's diversification. This is one of many strategies Stated Bridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth objectives. Many investors believe they're diversified simply because they own many different stocks. But owning 50 tech stocks isn't true diversification. If they all decline together, the portfolio still experiences significant losses. True diversification means owning investments that respond differently to changing market conditions. Some assets perform well during economic growth. Others may perform better during inflation. Some may benefit from falling interest rates. Others may be designed to perform during periods of elevated market volatility. The goal isn't to predict which investment will outperform next. The goal is building a portfolio that can remain more resilient across different market environments. Now here's how alternative investments can complement traditional investment portfolios. Notice the word complement. Alternative investments are generally not intended to replace stocks or bonds. Instead, they may help improve the overall portfolio. Traditional portfolios often rely primarily on market appreciation. Alternative strategies may seek returns from different sources. Adding multiple potential return drivers can help diversify portfolio risk. Some alternative strategies place risk management at the center of the investment process. Rather than attempting to predict market direction, they focus on controlling downside exposure. Examples include defined risk option strategies, market-neutral investments, hedged portfolios, and traditional asset allocation. While no strategy eliminates risk, managing it proactively can be just as important as pursuing returns. One area that's becoming increasingly popular among sophisticated investors is market-neutral investing. These strategies generally seek to reduce dependency on whether markets move higher or lower. Instead, they may attempt to generate returns from pricing inefficiencies, volatility, or relative value between securities. The objective is not necessarily to beat the stock market every year. Instead, it's often to produce more consistent risk-adjusted returns while reducing exposure to the broad market movements. This is one of many strategies DataBridge Capital Management applies when managing non-directional investment portfolios. It's important to understand that alternative investments aren't risk-free. Some may involve less liquidity, higher fees, and limited transparency. Because of these characteristics, investors should understand how a strategy works before investing. Every investment should fit within an overall financial plan and risk tolerance. You might ask this question: how should investors allocate? There is no universal answer. The appropriate allocation depends on investment objectives, time horizon, and risk tolerance. Pension funds, universities, endowments, and family offices often dedicate a meaningful amount of proportion to their portfolio to alternative investments as part of their diversification strategy. The objective isn't replacing traditional investments, it's enhancing them. Markets are consistently evolving. Alternative investments can provide traditional diversification, new sources of return, and potentially improved risk management when used thoughtfully. The key isn't chasing the newest investment trend, it's building a portfolio designed to withstand a variety of market environments over the long term. To learn more about DataBridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links in the description box below.